Russia's plan to use India as a backdoor entry into Europe seems to be working. Russia has been able to navigate Western sanctions well enough to push oil exports above levels reached before its war on Ukraine, and new data suggests that Moscow has China and India to thank for that. In the first quarter, Russia's seaborne crude oil exports totaled 3.5 million barrels per day versus 3.35 million barrels in the year-ago quarter, the tail end of which saw the start of Russia's war on Ukraine. China and India now account for roughly 90% of Russia's oil, with each country snapping up an average of 1.5 million barrels per day. According to commodities analytics firm Kepler, that's enough to absorb the shipments that no longer head to European nations, which used to account for nearly two-thirds of Russia's crude exports. Europe now takes in only 8% of Russia's oil exports, per Kepler. Both China and Russia are taking advantage of discounted Russian crude, benefiting from the sanctions applied on Russian materials by other countries. Behind China and India, Turkey and Bulgaria are the biggest buyers of Russian crude. Even before Vladimir Putin launched his war on Ukraine, China was already a top buyer of Russian crude, importing 25% of its crude from the country in 2021. That's since climbed to 36%, Kepler data shows. India, the world's third-largest oil importer, relied on Russia for about 1% of its total volumes prior to the war, but now buys 51% of its oil from Russia. The U.S. has led Europe and other Western nations in imposing sanctions and energy price caps on Russia, designed to maintain market flows while curtailing Moscow's export revenue. European central bank calculations show trade volume between the euro area and Russia has halved since February 2022, with the bloc's imports of Russian imports seeing particularly steep declines following the bans on coal in August 2022, crude oil in December 2022, and refined oil products in February 2023. The ECB chart below shows a similar pattern illustrated in Kepler's data, with Russian seaborne crude exports shifting toward Asian buyers and away from Europe. To be sure, the revenue Russia generates from its energy exports has fallen along with the drop in prices, even as volumes remain elevated. The International Energy Agency said Friday that Moscow's revenue is down about 43% compared to the same time last year. But oil prices are heading back up as China's reopening economy drives demand while OPEC and Russia pinch supplies. Earlier this month, OPEC Plus announced a surprise production cut of over 1 million barrels a day. When a trade flow change comes unforeseen, price transparency becomes the need of the hour for market participants eyeing a piece of that trade. The Russian invasion of Ukraine in 2022 resulted in significant upheaval for global crude oil markets, both for prices as well as for trade flows. One of the most talked about phenomena for oil markets in the last 1 year has been the realignment of Indian crude oil flows, with an ever-increasing flow of Russian cargoes into the South Asian country. Indian refiners have not been traditional consumers of Russian crude owing to the geographical distance and logistical inefficiencies from smaller vessels. The world's third-largest consumer of oil, which was heavily dependent on Middle East, West African, and U.S. crude oil imports, found a cheap crude oil source in Russian barrels as European countries started shrugging them away post-Russian invasion. The European price cap, which took effect in December 2022, has not helped Russian crude flows to Europe. But more of it continues to flow into India and China on a massive shadow fleet of tankers believed to have been built up ahead of the price cap implementation. Trend is here to stay. The Urals crude oil grade was historically supplied into Europe using a massive network of transcontinental pipeline networks and through ports in the Baltic as well as Black Sea. Owing to its geographic proximity, most of the Russian barrels used to find home in European refiners. Therefore, the price of the grade was assessed at Rotterdam and represented the value that mainly European refiners saw in the grade. Since that trade has been replaced by a novel flow to India, there have been wide market speculations on the level of prices Indian refiners have been paying for the distressed grade shipment in small-sized Aframax vessels. In addition, difficulties in securing insurance, hurdles in securing ships and financing, as well as payment-related issues meant that the landed price of these barrels to Indian refiners are looking quite different as compared to the CIF Rotterdam price for Urals crude. Among the keen watchers of this market include various regulators, government and non-government entities around the world, trying to find the value of Russian crude oil to determine how the efforts to curtail oil revenues has been working. The crude oil trading community have been watching this flow keenly as well, since invariably the deeper discounted barrels from Russia has been giving tough competition to spot barrels from the Middle East, West Africa, as well as the Atlantic Basin. For instance, the price of some key Nigerian grades preferred by Indian refiners saw some downward pressure in 2022 as the refiners were looking towards Urals crude to fill the spot volumes instead. Russian oil flows to India have been barely a year old. but at around 1.5 million BPD, it already makes up more than 30% of Indian crude oil imports. The massive inflows seem unlikely to dissipate anytime soon owing to the geopolitical situation in Europe, where the negative sentiment towards consuming Russian energy is expected to remain for now. The flow of Russian oil into India has mostly remained on delivered at port DAP terms, as the unconventional logistics of Urals into India looks difficult for domestic refineries to handle, while economic incentives of discounts are large enough to keep the interest alive for those cargoes in the foreseeable future. The independently assessed value of Urals crude in India provides much-needed transparency on the value of Russian crude oil being delivered into the South Asian country. Since the launch, there has been significant interest in the assessment as analysts, governments, refiners, traders, sellers, and buyers have started to get a fair understanding of the price for one of the most talked about oil flows in the world. The price has been keenly watched by various market participants and used as an important point of reference when trading Russian crude oil volumes, especially when the same is being traded through non-traditional supply sources. The flow of this oil and its economics will continue to remain a key theme in the Indian refining space that continues to grow in size, making India an important source of global oil demand growth. India's refining runs are expected to grow from 5.25 million BPD to 5.9 million BPD by 2025 as fuel demand continues to grow at 4.50%. Price assessments not only bring some clarity in the opaque post-invasion world of Russian oil flows, but also signals an important reference point for the wider market, which directly or indirectly is impacted by this trade flow realignment. The yuan surpassed the dollar in monthly trading volume in February for the first time, and the difference became more pronounced in March, according to data compiled by Bloomberg based on daily transaction reports from the Moscow exchange. Before the invasion, the yuan's trading volume on the Russian market was negligible. The switch comes after additional sanctions this year affected the few banks in Russia that retained the ability to make cross-border transfers in dollars and other currencies of countries branded unfriendly by the Kremlin. Raiffeisen Bank International AG, whose Russian branch remains one of the main conduits for international payments in the country, was among lenders that came under elevated pressure from European and US authorities. Russia has deepened its ties with China since the February 2022 invasion prompted a break in relations with the West. In March, Chinese President Xi Jinping made Moscow his first visit abroad after his re-election and promised the Kremlin expanded cooperation in the areas of trade, investment, supply chains, mega-projects, energy, and high-tech. Sweeping sanctions targeting Russia's financial system have forced the Kremlin and Russian companies to switch their foreign trade transactions from the dollar and euro to currencies of countries that have declined to join any restrictions. The finance ministry converted its market operations to the yuan instead of the dollar earlier this year and developed a new structure for the National Wealth Fund to hold 60% of its assets in yuan. The Bank of Russia regularly calls on companies and citizens to move their assets into the ruble or friendly currencies to avoid the risk of having them blocked or frozen. Despite all that, the dollar remained the most popular currency on the Russian market until now, only rarely losing out to the yuan in terms of volumes on any given trading day, according to exchange data compiled by Bloomberg. Also, although the yuan has been more popular in Russia, China's capital account controls as well as geopolitical concerns among global investors remain a barrier as Beijing seeks to promote the currency's usage overseas. Global foreign exchange reserves allocation in the yuan accounted for about 2.7% of the total amount by end of last year, down from the peak at 2.9% in the first quarter, IMF data showed. Now there are fewer dollars on the market as Russia's revenues decreased due to the oil price drop and a decrease in exports. At the same time, commodity imports from Russia to China are up by 29%,